Hello, very good morning to all. I'm Kelvin here again. Welcome to today's Daily Dose of Market Insights. Very good morning. Today will be Thursday, the 15th of May, 2025. So as usual, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, let's have a quick recap on what has taken shape yesterday in terms of news flow, economic data release, as well as any potential economic data release that earlier this morning that could have a significant impact on those broad-based cross-asset classes that we cover on a daily basis. This is i.e. the major dollar pair, the major stock indices, as well as the two key commodities, gold XAU/USD and West Texas crude oil. So let us start with let us review the performance of the major US stock indices yesterday first as well. So yesterday was rather a choppy session in the US in the US stock market as we start to see profit taking activities coming into play on after this Monday strong rally across the board that is being seen in the US stock market, reinforced or fueled by that US-China de-escalation optimism, where we right now hit into the 90-day pause between these two superpowers, where they will actually reduce their trade tariffs among one another. And what we could see is that among the choppy session yesterday, the stellar top performers still remain at the Nasdaq 100, being the higher beta major stock indices, driven by the gains of the mega cap technology stocks, up by 0.6%, the SPX marginally up 0.1%, and the Dow Jones and the Russell 2000 underperformed, negative 0.21% and negative 0.9% for the Russell 2000 respectively. So this intraday performance came in within our expectation yesterday, but I do highlight that the short-term intraday technical outlook on the Nasdaq 100 still remains positive towards that 21,400 resistance level, whereas the Dow Jones Industrial Average continues to see a bit of a weakness around that 200-day moving average at the 42,480 level, and it slid down and hit our first support at around the 41,700 level. So later I'll cover the latest technical outlook on the Dow Jones Industrial Average. In our platform is represented by the US Wall Street 30. What is the latest trend bias for today? And the reason why the Dow Jones underperformed was actually this negative spillover impact from United Healthcare, which is a healthcare stock that has a significant weightage in the Dow Jones Industrial Average, and this healthcare stocks this United Healthcare stock continued to splutter downward yesterday, and that causes a negative feedback loop into the entire healthcare sector in the S&P. Right, so once you see that this healthcare sector is deeply in the red, and why the S&P yesterday managed to close up marginally higher at 0.1%, thanks to NVIDIA, which is still having that positive feedback loop after prior day positive news release where US allows US semiconductor company to sell more of its AI related products to the Middle East. All right, so that's why NVIDIA continues to shape that positive feedback loop and manage to allow the S&P 500 close up marginally higher at 0.1%. All right, so that's for the performance of the FX market. And news flow pertaining to the dollar FX market is that we start to see the dollar strength subsiding. So that also came in within our expectation as well, where we expect the euro, the sterling to strengthen against the dollar, and as well as the Aussie to strengthen against the dollar, with the dollar yen inching downwards as expected. All right, so the reason why the dollar weakened yesterday is during the late Asia session that this particular news flow out from Bloomberg stating that right now we know that US is now hosting various various number of trade negotiation talks with key trading partners. So the major one has already passed UK, China, and right now still ongoing Japan, South Korea, India, more or less a done deal, and as well as some of the other Southeast Asian nation country like Vietnam also. So what we could see over here is that yesterday, Bloomberg has a report stating that President Donald Trump favors a weaker greenback and will prompt other governments to let their currency rise in return for trade deals with the US. So this I highlighted a couple of times in our daily dose of market insights is that the overarching theme of Trump's trade tariff policy is to reduce U.S. significant trade deficits against its trading partner, and as well as allowing U.S. to become a major trading hub of key resources. All right. In order to achieve that, the net result will be a weaker dollar. That means countries that are being faced with a high tariff, in order to reduce this high tariff, the carrot US give or the negotiation tool is that they will force these countries significant trade surplus with the US in order to reduce their currency got to weaken against the dollar. And in this ongoing trade negotiation with South Korea, there was a report stating that US and South Korea officials discussed the exchange rate policy, and that kind of a freak market out that we may have start to see a Plaza Accord 2.0. So those who recall Plaza Accord is where the major developed nation forced Japan to actually appreciate the Japanese yen at that point in time. So right now we may start to see a Malengo Malengo Accord, which is similar to the Plaza Accord, where US now is forcing their targeted trading partners currency to strengthen against the US dollar in order to achieve the current US White House administration aim of reducing its significant trade deficit, and as well as allowing US to become a major manufacturing hub for key resources. All right, so that's actually explain why the dollar weakened yesterday, which is coming in line with our technical analysis outlook as well, where we actually favored bearish trend buyers in the last 2 days for a weaker dollar against the major currency. And what's interesting over here is that due to this technical weakness momentum on the gold XAU slash USD. So if you look at gold price over here, let me share with you the screen of gold. All right, let me open up this chart. So gold price yesterday continues to weaken, primarily more driven by positioning and technical factor rather than a change in the longer term fundamentals. All right, later I'll explain to you why the longer term fundamentals still remains favorable for gold XAU slash USD. So let me share with you the short term price movement of gold first by looking at the daily chart of gold XAU slash USD. So for those who follow our daily dose of market insight for gold, since the start of this week, we flipped to a intraday trend bearish bias, anticipating the start of a potential kind of a multi-week corrective decline scenario. So what you could see is that gold has really started to decline significantly since the last push up on 6th of May, and it's really lasted for about a week already. So the potentially gold price could continues to weaken further. So yesterday it was down negative 2.2%, and today Asia session as we are speaking is extended its losses to negative 0.8%, negative 0.8%. And the reason for this fall over here is due to over positioning. Short-term players are rather bullish, especially this bullish breakout on the 5th of May. All right, over here, and after that it broke below the 20-day moving average on this Monday after that trade we call it de-escalation, trade tension de-escalation between US and China gained traction, and with that lead to a downside momentum in the short term to resurface and caught those late leverage long players off guard. So that actually explained the fall in gold price XAU/USD. But the long-term fundamentals for gold still remains intact. That means, i.e., the major bullish trend of gold still remains intact since 2023, all right, and 2022 over here. All right, since 2023, this is the major ascending channel low and still holding firmly above the 200-day moving average. Okay, and the fundamental drivers that is still supporting this major uptrend in gold right now, that means, i.e., right now we are seeing a potential medium-term corrective pullback in gold, that means multi-week pullback within a multi-month major uptrend phase that is still intact. And the reason why this major uptrend phase is still intact for gold is due to these fundamental drivers that US so-called expectation of higher inflationary trend is still prevalent in the US economy. So this is the still recall those who actually I mean, in the past has followed my daily dose of market insight, I tend to flash out this chart. So this chart is actually a combination of key, we call it leading macro economic indicators. So let me very briefly touch on the dark blue line and the light blue line. So this is a 5-year. The dark blue line is the 5-year US break-even inflation rate, and the light blue line is the 10-year US break-even inflation rate. Think about this: at 5-year is medium term, 10-year is long term, and this US break-even inflation rate is actually market transacted pricing on the US Treasury inflation protection securities, where from there we are able to derive market expectation in this asset class, their view on future inflation trend in the US. We know that CPI data is always lagging because CPI data is for the month of April. The latest was April. By the time it moved toward May, June, July, market may have already anticipated a higher inflationary trend. And what market is anticipating right now in the next 5 years from today, which is this one, I mean the 5-year break even, inflation trend is expected to be at 2.4%. And 10-year from today, which is the 10-year break even, the one in lighter blue, will be up at 2.37%. So both of them actually rallied from their 31st of March swing low area over here. So there's a big V-shaped recovery over here. So what it means that despite the fact that the US-China de-escalation, we call it narrative, has gained traction since Monday, but the damage has already been done, i.e. market participants are still getting a bit of worrisome that future inflation trend in the US may be sticky on the upside. So that's the reason why they push up the 10-year US break-even inflation rate and the 5-year US break-even inflation rate, anticipating higher US inflationary trend in the future. So with this higher US inflationary trend in the future, coupled with rather weak consumer sentiment that is still prevailing in the US economy, that actually is a concatenation of stagflation risk. So stagflation risk is still prevalent in the US market or the US economy. So that should actually support that will be the potential fundamental driver to support the major uptrend phase of gold XAU/USD that I shared with you guys earlier on in the chart earlier. All right, so this is the fundamental driver, all right, that supports the long-term major bullish trend of gold that is still pretty much intact in my view. Right, another news flow over here is more pertaining to the Chinese and Hong Kong stock market. So the Chinese and Hong Kong stock market yesterday continues to rally, and that has been driven by one of the major component stock in the Hang Seng Index and Hang Seng Tech Index, which is Tencent. So Tencent reported its Q1 earnings yesterday, where its what you call it, its bottom line and its net revenue grew the fastest since 2021. All right, so that actually created a bit of optimism in the China and the Hong Kong stock market, stating that going forward with this ongoing, we call it a fiscal stimulus plan that the top China policymakers is going to potentially enact according to the situation between US and China relationship, that could actually further boost the uptrend, the major uptrend phase that has been intact since the start of this year. That's more than about 3 months. I would say medium term first, the medium term uptrend phase of the Hang Seng Index, which is up since the start of this year, which is already more than 3 months, continues to actually power up on the upside. All right. that what we could see over here is oil price. So oil price yesterday, even though it actually rallied slightly, but it can't break above our resistance level and starts to tumble downwards. So what do I mean by this? So if we could look at the WTI crude oil price on the daily chart, which is the West Texas crude oil. So we do highlight that despite the rally that was seen on Monday, Tuesday, over here is a corrective rally, and in that bearish reaction right at the 50-day moving average, where we highlighted on the last 2 days, where we have our bearish bias on our intraday technical trend bias. And the reason yesterday's oil price fall was due to, or today's oil price early morning fall by negative 2.1% is due to this news flow, where US right now is Trump is in the Middle East to actually struck some deals, and also together with this thorny US-Iran issue that was pretty frosty during the Biden administration. So it appears that US and Iran has come to some compromise, where Iran will stop we call it its nuclear program, or kind of slow down its nuclear program, and US being we call it being in this kind of strategic discussion with Iran allows the degree of sanction to be lifted on Iran oil exports. So going forward in the next couple of months, we may start to see Iran oil flooding into the global oil market. So that create an increase in supply of oil, together with the ongoing production heights, not production cuts, production heights, as agreed among OPEC Plus member. So that actually put a cap on oil prices that has rose in the last 2 days due to this US-China trade de-escalation optimism. So going forward, oil may trade in a choppy range, but more towards the downside bias, because there's still abundant of supply of oil in the oil market. So later I'll touch on the key levels to watch again on the intraday technical outlook. All right, so that should sum up the first segment of today's daily dose. So let us now proceed to the second segment of the daily dose, which is the intraday technical outlook on those major cross asset classes. So as usual, let me expand my screen. All right, let me expand my screen. Okay, this should be working. All right, good. So let us start with the FX market first over here. All right, so let me start with the euro dollar. So the euro dollar continues to rally as expected. So yesterday it rallied, almost hit the resistance zone that we highlighted at 1.1280, 113.30, which is still the current minor descending trend line that kept previous rally in place from the high of 21st of April, and also confluence closely with the 20-day moving average. And what's interesting is that during the later part of the US session, it staged that pullback, and that pullback managed to do a minor V-shaped recovery as we're speaking right now, right above our first stated support level at 111.40. And with that, the hourly RSI now has inched back up above the 50 level mark as well, indicating that on the intraday, on the short-term basis, bullish momentum potentially has resurfaced for the euro dollar. So given that it still can't break above the 1.1280 / 113.30 resistance zone, I would not be so aggressive and shift our short-term pivotal support up to the 111.40 level. I'll still maintain it at yesterday at the 1.11 figure level over here. So 1.11 will be still my short-term pivotal support level for euro dollar, still maintaining our intraday trend bullish bias on the euro, given that short-term technical element is still positive, as highlighted by the hourly RSI inching upward above the 50 level. Above 113.30 may see the next intermediate resistance coming in at 114.25. Only a breakdown and hourly close below 111 will negate today's intraday bullish bias to see a retest at 110.50. Only a breakdown below 110.50 will trigger off the extension of this corrective decline situation or sequence that is still in place since 21st of April to expose the next near-term support zone at 1090 10940/108 1.0890, which is the minor swing low area of 7th of April, 9th of April, and 10th of April this year. Okay, so that's for the euro dollar, still maintaining the intraday trend bullish bias using 111 figure as the short-term pivotal support. Up next will be the sterling dollar. So the sterling dollar yesterday cleared above our first resistance at 133.20, can't hit the second resistance at 134.20 before reintegrating back below the 20-day moving average, but managed to find a support at our predetermined first support level at the 132.54. So given this whipsaw around the 133.20 level, I do not want to be so we call it aggressive and tighten the short-term pivotal support to the first support level that we highlighted yesterday at the 132.54. So I'll be still using 132 figure level as my short-term pivotal short-term pivotal support. I repeat, I'll be still using the 132 figure level as my short-term pivotal support level to maintain that intraday trend bullish bias for the sterling dollar. An hourly close above 133.20 at the start of the European session thereafter will further reinforce the trend intraday bullish bias to expose the next intermediate resistance or near-term resistance at 134.20 next. However, if we start to see a price push down and a bearish breakdown with an hourly close below 132 figure level, today's intraday trend bullish bias will be negated to see a choppy downward drift to retest 131.20, which is close to the rising 50-day moving average. Below 131.20 may see the extension of this ongoing corrective decline phase that is in place since 29th of April to expose the next intermediate or near-term support level at 130.50. Right, so i.e. still maintaining that trend intraday, that potential intraday trend bullish bias using 132 figure level as my short-term pivotal support for the sterling dollar. Next up will be the Aussie dollar. So the Aussie dollar managed to stage a bounce right exactly at the 20-day moving average and slightly above the 64 figure short-term pivotal support that we highlighted yesterday. And also the hourly RSI has managed to trace out a higher low as well, and right now is trying to inch back up above the 50 level mark, indicating a build-up of potential short-term intraday bullish momentum for the Aussie dollar. So with this positive element still remains intact on the Aussie dollar as per highlighted to you guys earlier, 64 figure level will indeed be still remains my short-term pivotal support, maintain that intraday trend bullish bias. First resistance to watch out will be 65.15, no change, which is close to the minor swing high that was seen on yesterday, Wednesday, before it did that pullback. Above 65.15 may expose 65.20/65.50 next, which is the graphical congestion area or the minor swing high area of 20th of November and 25th of November last year. Right. However, if we start to see a price action breakdown with an hourly close below 64 figure level, today's intraday trend bullish bias will be invalidated to see a choppy downward move to retest that range support that is in place since 16th of April at 63.60/63.30 with so confluence with the rising 50-day moving average. So i.e. still using 64 figure level to maintain that intraday trend bullish bias for Aussie dollar. Lastly will be the dollar yen. So the dollar yen plummeted as expected, hit our first support level at around the 46 and 45 80 46 figure mark. Then thereafter it did a pullback. Then after that pullback can't break above, or that snapback rally can't break and do another inverted V-shaped bearish reaction where the hourly RSI got rejected right exactly at the 50-day 50 level, pardon me, where the RSI got rejected at the 50 level and inch downwards. And prior to that push up, there is no bullish divergence on the hourly RSI. Okay, hourly RSI continues to shape a lower low over here, so indicating that the downside the short-term intraday downside momentum is still intact for the dollar yen. So with this bearish momentum that is still at play on the intraday basis on the dollar yen. We will still maintain our intraday trend bearish bias for the dollar yen using a slightly tightened short-term pivotal resistance for today. We shift down from 14870 to 14775. So 14775 will be my first, it will be my pivotal resistance for today, slightly above our first resistance level of 147 figure level. So as long as 14775 short-term pivotal resistance holds, we'll still maintain that intraday trend bearish bias. Near-term support level to watch will be a zone at 14540/14495. A breakdown below 14495 exposes the next near-term support level at 14410, which is also the which is also the 20-day moving average as well. However, a price action bullish breakout with an hourly close above 14775 that would invalidate today's intraday trend bearish bias to see a retest at 14870. Only a breakout above 14870 will see the extension of this ongoing corrective rebound sequence from the low that is still in place from the low of 22nd of April to see the next intermediate near-term resistance zone to come in at 14990/15030, which also confluence with the key 200-day moving average, acting as a similar resistance level as well. So i.e., in a nutshell, still maintaining that intraday trend bearish bias on the dollar yen using a slightly tightened short-term pivotal resistance for today at 14775. Okay, that sum up the intraday technical outlook on the major dollar pair. So let's turn our extension to the major stock indices, starting with the Hong Kong 33, i.e. representing the Hang Seng Index. So with that, the Hong Kong 33 yesterday managed to stage the bounce as expected, hit the resistance level at 23,740. But however, with this higher high on the price action on the Hong Kong 33, we start to see the RSI showing some form of bullish exhaustion by shaping a opposite direction with the price action by shaping a lower high right at the overbought level, and price action has started to reintegrate below the overbought level after this bearish divergence condition. So this indicating that in the very short term, the intraday bullish momentum has started to ease off, where the Hong Kong 33 right now may shape a minor pullback within its short-term uptrend phase that is still intact, as price action managed to still trade within this minor ascending channel of 16th of April. So right now it's more like a minor corrective decline slash mean reversion decline to retest the lower limit of this minor ascending channel. So for today, we will flip to a intraday trend bearish bias for this potential minor corrective decline slash mean reversion scenario to play out, using 23,740 as my short-term pivotal resistance level. Two near-term support level to watch out for today, 23,200 followed by 22,970. Only a push up and a breakout above hourly close above 23,740 will invalidate today's intraday corrective decline slash mean reversion minor scenario to see the continuation of the impulsive up move sequence extending to the upside, exposing the next near-term or slash intermediate resistance zone at 23,970, 24,040 followed by 24,350, which is the 1.382 Fibo extension from the low of 9th of April, and as well as this minor congestion area of 7th of March, 17th of March, and 20th of March. So that's for the Hong Kong 33. Next up will be the Japan 225 representing the Hang Seng next up will be the Japan 225, pardon me, representing the Nikkei 225. So still recall in the last 2 days, we still have that intraday trend bearish bias for that corrective setback scenario to play out, and indeed it played out as expected, hit our first support level at 37,870 before trading downwards, and right now is a retest above this level over here. There's a retest of it before shaping that minor inverted V-shape negative price reaction. And also, it also broke below this former minor ascending channel support, now turns into a pullback resistance at 37,870. And if you look at the hourly RSI, the hourly RSI hasn't hit the oversold level yet. All right, and price action continues to display a series of lower high. Okay, what you can see over here, and lower low. Okay, there is no bullish divergence at all. All right, so indicating that downside momentum in the shorter term still remains intact for the Japan 225. So with that, we will have a slightly tightened short-term pivotal resistance for today at 38,470. So using 38,470 as my short-term pivotal resistance level, we'll still maintain that intraday trend bearish bias for the extension of this minor corrective decline setback scenario to unfold. Next near-term support level to watch 37,280, below 37,280 exposes 36,630 next, which confluence with this rising 20-day moving average. Only a price action push up with an hourly close above 38,460 that would invalidate today's intraday trend bearish bias to see a retest of 38,850. Only a breakout above 38,850 will resume the impulsive upmove sequence to see the next intermediate slash near-term resistance coming in at 39,480. So that's for the Japan 225, still maintaining our intraday trend bearish bias using a slightly tightened short-term pivotal resistance at 38,460. Next up will be the Germany 30 representing the German DAX. So the Germany 30 and the German DAX continues to drift in a sideways range since last Monday rally over here. And right now price action is attempting to actually break down, because today right now is still the Asia session where liquidity is very low, not really a convincing bearish breakdown below the minor ascending channel support from the low of 11 April. Given that it's in the Asia session where liquidity is very low, this doesn't really constitute a high probability bearish breakdown for the minor ascending channel. So with this tight sideways range that is still in place since Monday, we will flip to a neutrality stance for today, neutral between 23,790 and 23,380. Only a bullish breakout and hourly close in the European session above 23. Once the European session kickstart thereafter above 23,790, then that would resume the impulsive upmove sequence of the Germany 30 for the next intermediate resistance slash near term resistance zone to come in at 24,170 slash 24,190 before 24,440 slash 24,560. So these are fresh all-time high levels being determined by a class, the Fibo extension clustering technique. All right, so that's for the Germany 30. Flipping to a neutrality sideways stance for now between 23,790 and 23,380. Next up will be the major US stock indices, starting with the US Wall Street 30, representing the Dow Jones Industrial Average. So yesterday we do have a bearish bias below 42,480. It's now hit our first support at 41,770, and also the RSI also hit the oversold level as well, oversold region. So there could be a chance that right now this minor pullback scenario has already ended for the US Wall Street 30. So using a slightly lower pivotal support zone, which is the gap up on this Monday at 41,350, 41,135. We also confluence with the 50-day moving average acting as a similar support as well. We will flip to a intraday trend bullish bias for the US Wall Street 30 for today. First resistance to watch will be around the 200-day moving average that got rejected earlier on Monday at 42,480. Above 42,480, we'll see a high probability a continuation of the impulsive upmove sequence to expose the next intermediate resistance at 43,085, which is the 1.236 Fibo extension from the low of 7th of April, and as well as the minor swing high of 5th of March and 6th of March this year. However, if price action continues to tumble and break down below 41,135, that will see the extension of that minor corrective decline sequence to extend downwards to the downside, exposing the next near-term support level at 40,690 slash 40,430, which confluence with the rising 20-day moving average, and as well as the lower boundary of this ongoing minor ascending channel support from the low of 7th of April. So i.e. flipping to a intraday trend bullish bias for today, because more likely the minor pullback sequence may have already ended, using 41,350 slash 40,135 on the US Wall Street 30. Next up will be the Nasdaq 100. So Nasdaq 100 continues to remain on the stronger footing. For today, yesterday tried to grind slightly upwards higher, but still holding below the 21,400 first resistance level that we highlighted yesterday. So with that, first support level to watch out for will be 21,180, using a slightly lower level, which is the minor swing high area of 12th of April and 13th of May now turns into a pullback support, which is at 20,900. So 20,900 will be my adjusted short-term pivotal support level for today for the Nasdaq 100. Still maintaining that intraday trend bullish bias, but that may be a last push up before a much more substantial minor corrective pullback phase takes shape. Based on the elliott wave perspective, because that is a minor wave 3 target at the 1.382 Fibo extension, and also the hourly RSI has started to shape that bearish divergence as well. All right, so this is only a potential last push up before a minor corrective pullback sequence unfold that could last a multi-day perspective. All right, at 21,750, which is the next, which is the key inflection resistance level to watch to kickstart that potential minor corrective multi-day pullback sequence. However, if price action immediately just break down below 20,900, then this residual push-up scenario will be invalidated to kickstart that potential minor corrective pullback sequence that could last from a multi-day perspective, exposing the next support level on the downside at 20,690, followed by 20,390, then thereafter that 20,110, which coming very close to the key 200-day moving average as well. All right, so that sum up the intraday technical outlook on the major stock indices. So let us now proceed to the commodities asset classes, starting with gold XAU/USD. So gold XAU/USD continues to slide downwards, hit our first support level at 31,093. Now turns into a pullback resistance level in today's Asia session, where it got rejected of it. So this will be my first resistance level to watch, 31,093. Now with a slightly adjusted downwards pivot, 32.25, which is the minor range support of 13th of May, and lasted during yesterday's start of the European session before it shaped that bearish breakdown. So this will be my Titan short-term pivotal resistance for today for gold XAU/USD to maintain that intraday trend bearish bias for this ongoing corrective decline sequence that is still in place since 22nd of April high. So next support level to watch will be 31.33, which is the 50-day moving average. A breakdown below it exposes 30.86/30.55, which is the lower limit of this medium-term ascending trend line from the low of 31st of December. However, if price action managed to see a recovery and a bullish breakout and hourly close above 32, 30.25, then this potential minor corrective decline sequence may have ended to start to see the start of a much more substantial recovery. So in first step, the next resistance level to watch will be 32.91, followed by 33.60. So IE still maintain that intraday trend bearish bias for gold XAU/USD using a slightly downward adjusted pivot. The resistance for today at 32.25. Next up will be the West Texas crude oil. So West Texas crude oil, if you still recall on yesterday, we still maintain our intraday trend bearish bias using 63.88 as my short-term pivotal resistance level, which is confluence with the downward sloping 50-day moving average as well. Price action indeed rejected off this level and hit our first support level at 61.60 as we are speaking right now, which confluence with the 20-day moving average. So with no clear bullish divergence, because as price action continues to shape a lower low over here, so potentially now it's bouncing off from the oversold region, so it could be just a minor bounce before another downside takes shape. All right, so minor bounce resistance level to watch out for as the European session gets underway in around 3 hours or 2.5 hour time will be this minor swing low turns into a pullback support, got rejected earlier at the start of today's Asia session at 62.90. But I don't want to tighten my short-term pivotal resistance to be so tight at 62.90 because it's the middle of this range resistance, which has been formed at 63.88. So still using 63.88 as my short-term pivotal resistance level for West Texas oil. Still maintain that intraday trend bearish bias below 61.60, exposes 60.35, below 60.35 may see 58 near-term support level coming in next. However, a price action bullish breakout and the hourly close above 63.88 that would invalidate today's intraday trend bearish bias to trigger off another round of minor corrective rebound extension towards the trigger off an extension of the minor corrective rebound sequence to expose the next near-term resistance level at 65.40, which is the minor swing high of 23 of April. Above 65.40, may see the next intermediate resistance coming in at 67.35, which is the minor swing high of 4th of April. All right, so that's for the West Texas oil, still maintaining that intraday trend bearish bias after a potential minor bounce that may take shape, holding below the 63.88 short-term pivotal resistance level. Okay, so that sum up the intraday technical outlook on the major cross asset classes as well. So before we go, let's take a look at the economic calendar. What are the key data to look out for today? So for today, at the start of the European session will be at 2 p.m., which is the preliminary Q1 GDP growth rate reading of UK that could influence the sterling dollar and the sterling crosses. So market expectation is expecting for a Q-on-Q increase or improvement to 0.6% from last quarter's Q4 of last year of 0.1%. But for on a year-on-year basis, market is expecting a slight reduction to 1.2% from 1.1% in last year Q4. And thereafter, as the European session progresses, we have a slew of ECB officials speaking. ECB Cephalon, ECB Alderson speaking at 3 p.m. and 3:50 p.m. over here. And thereafter, we have the PPI data. So US PPI data is considered as factory gate prices, that is, i.e. a gauge of cost of doing business for US corporation. 8:30 p.m. and you have the important retail sales, because given the fact that majority 3/4 of US economic growth is driven by the so-called services industry, where retail sales is part of them. So that will be at 8:30 p.m. Singapore time, where market expectation is a deceleration of retail sales to 0%, no growth, from 1.5% that was recorded in the previous month of March. All right, over here. Then what we could see over here is a rather quiet session. Then the all-important big boss Fed Chair Powell speech will be out at 8:40 p.m. Market participants will be scrutinizing his stance right now on the view of the US economic situation, especially inflationary trend and growth after last Monday push up in the US major stock indices triggered by that US-China de-escalation. Right, then thereafter you have 10 p.m. you have Bank of England Douglas speech, a Bank of England official speaking at 10 p.m. Singapore time. And at 2:05 a.m. Singapore time, you have Fed Bell speech. And before the start of tomorrow's daily dose, we have Tier 1 Japanese economic data to take note of. Will be the preliminary Q1 GDP rate of Japan, where market expecting a contraction of negative 0.1%. So that could potentially drive dollar yen rate as well as the yen crosses rate. All right, so and another news flow is more pertaining to the Hang Seng Index, where before the start of the US session today, we have the release of another China big tech stock earnings. Q1's earnings will be at Alibaba. So Alibaba market is expecting improvement on the EPS. So earnings per share will be at $12.60, improvement from the previous one a year ago at $10.14. So something to take note of as well. So that sum up today's daily dose of market insights. I'm Kelvin here signing off, and I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.